Let's work on the Webb Corporation question where they purchased an asset from Shaw Corporation on January 1st, 2016, and they accepted a 3-year non-interest bearing note for $18,000. And this note is due in December 2018 in exchange for the asset. Webb's incremental borrowing rate is 12%, so we'll use that in our computation. We need to prepare journal entries to record the issuance of the note, the retirement, and any interest expense in the books of Webb. So we're going to record first. Let's record the issuance of the note. So when we issue the note, and we did get the asset, so we're going to increase the asset. We were not given a name, so let's just call it asset, and the value of it is the present value of the note, like in terms of today's money. So we're getting the note is $18,000 in 3 years, so we're going to take $18,000, multiply it by the present value factor 12%, 3 years, that is 0.711780. So that results into 12,812 and 4 cents. With that, we also have a notes payable in our books now. So notes payable is 18,000. The difference between the two is our discount or note payable. So it's the same way as we do in bonds payable. So notes payable, the discount is the difference between those two. So discount or notes payable. And that's 18,000 minus 12,812 and 4 cents. So that's 5,187 and 84 cents. 96 cents, sorry. With that, let's record the December 31st entry for the interest expense. So even though there is no payment, it's a non-interest bearing, we still compute interest on the 12 based on the 12%. So December 31st, 2016, we'll have an interest expense as well as which will be our amortization for the discount on notes payable. The amount for this is going to be the 12,000. That amount there, 12,812.4 times 12%, since we already know Webb's incremental borrowing rate. So this becomes 1,537.44. So 1,537.44. Come December 2017, we'll do the same. So December 2017, we have an interest expense as well as a discount. We amortize the discount or note payable. And this time, we have already amortized the note from 12,812.4. We add the amortization from previous, so we had 1537 from last year, 1537.44, and we take this result and multiply that by 12%. So the amortization for this time is 1721.94. So 1,721 and 94 cents. The 2018, December 2018, we post another amortization. So interest expense and discount, we're going to amortize the discount again. discount on notes payable. We'll add the last two amortizations. So we had 12, 8, 12 and 4 cents plus 1537.44, and we're going to add the 1721.94. We add all that and multiply it by 12%. That's how we're getting the amortization for this year. So we have 1928.58. So we have 1928.58, and that's our amortization for this year. But let's combine this with the settlement of the note. So I'll erase this so that I get more space to put for the settlement of the note. So in addition to this interest expense and interest discount payable that we're settling, we're also paying for the note this time. So we're paying out cash of 18,000 because it's now matured, and we're removing the notes payable from our books. So I'm just combining the interest transaction with the settlement transaction. So notes payable is being removed from our books. So we have 18,000 on the debit side, and we also have an 18,000 of cash outflow on the credit side. So this is on December 31st, 2018, when the note is maturing. Note that this your number might be off by a little bit, by maybe 1 cent or 2 cents due to rounding error. So that concludes the requirements for this question.